Hey guys, good afternoon and welcome to the CNBC TV18 Mumbai newsroom. I'm Pavitra, with me is Sonal, and today we have two very interesting topics to discuss. First up, we are going to talk about the hybrid fund space, which is only picking up pace. We've seen a solid pickup in the flows which came through in July. So that figure is coming at over 12,000 crores, 12,500 crores versus just around the 4,600 crores that we had in June. And after that, we're also going to get you a chat on the rise of passives in India. Sona, like I mentioned, these are both spaces which are only getting hotter. So, it'll benefit our viewers as well.
Oh, yes, it will. And an interesting topic. So let's kickstart the show then. And first up, of course, we'll discuss all about hybrid funds. Joining us today is Ruchit Mehta, Head of Research at SBI Mutual Funds. Ruchit, good afternoon. Thank you so much for joining us today. As Pavitra was mentioning,
good afternoon.
There has been a big surge in flows that we saw in hybrid funds in the month of July. What do you suggest? Why should one look at hybrid funds? What is the outlook here? And how does it fit into a client's portfolio?
Sure. Thank you so much for having me on the show. I think when investors look at the current state of markets, there obviously have been a lot of concerns with regards to the way valuations have been, especially in, say, the mid and small cap category, where we've seen a lot of money flow, as well as a lot of stocks have given very solid returns in the last 1 year or so. So when there is a bit of uncertainty on the markets, it is best perhaps for an investor to look at some allocation of their portfolio to a hybrid fund, because in many cases, a hybrid fund will be able to very nicely manage the allocation between debt and equity and give some bit of a downside protection, especially if markets turn out to be volatile going forward.
All right. Hi, Ruchit. Thanks a lot for joining us. It's good to have you on the show. But, Ruchit, no one is contesting that it's a good idea to have equity and debt both in your portfolio. But the question is, what is the advantage of picking a hybrid fund over, doing this kind of distribution yourself? I mean, if I'm an investor, I can go and buy some equity and some debt funds by myself, right? What is the benefit of picking a hybrid fund in this space?
Sure. I think the most simple advantage of a hybrid fund vis-a-vis doing it by yourself is that it brings in a lot of discipline, right? If you were to do it by yourself, you would need to be fairly disciplined with regards to the kind of asset allocation that you would need to maintain. Here, the fund manager or the fund management house will do it for you automatically. The second is that you will also incur a higher cost of doing it by your own self, right? Because typically you'd buy, let's say, a pure equity fund, some allocation to, say, an arbitrage fund, or some allocation to a debt fund. Effectively, your cost would be much higher than buying a pure hybrid fund itself. And third is that you probably have a worse of tax situation, by having three different individual funds rather than having one single fund that's there in your portfolio. So I think having it through a mutual fund is a much more efficient way. One, it's obviously a lot more disciplined. The asset allocation is managed for you. The cost can be lower, and the tax structure can be a lot more better through a single unit rather than doing it individually through three different products itself.
That makes sense. It's very important to look at the cost structure and the tax bit as well, apart from the returns that you can expect from a particular fund. But Ruchit, can you explain the laddering of risk and return through hybrid funds, creating an incremental bridge from debt to pure equity? How does that work?
Sure. I think this is a very important aspect. A lot of investors typically avoid investing into equity funds because historically equities have a higher degree of volatility compared to, say, debt mutual funds. Even debt has a higher bit of volatility compared to, say, simple fixed deposit products that's there. So customers typically tend to shy away from investing into equity, or will have a very small amount of equity allocation in their portfolio. So a hybrid product is actually a very efficient and a nice way to expose an investor to investing into equities. And over a period of time, their experience into investing, they can keep increasing the risk exposure by moving from one bucket of hybrid product to another. So if you take the pure risk return spectrum, right, debt would be at the lower end of the risk spectrum and the lower end of the return spectrum, and at the top end you would have equity. And between those two extremes, you have hybrid products, right, which starts off with the very basic of a debt hybrid, where your equity exposure is about 25%. You probably move up a notch higher to an equity savings product, which is about 35%. A multi-asset product can be about 40-45% equity. It also has the added advantage of having an exposure to an asset class such as gold. and you can have a balanced advantage product which can have a slightly higher equity of about 50-55%, and then an equity hybrid which is at 65-70%. So for an investor who's never been into equities, you can start off with the debt hybrid and then progressively move higher as you keep meeting your investment and return guide expectations.
Okay, I think that's very important to put on the table as well, that even within this space, there are so many different options that you can pick according to whatever, really suits you best. Ruchit, but Sonal was also mentioning that the taxation bit is also very important, right? Could you take us through how that works for the different kinds of hybrid funds, both equity oriented and non-equity?
Sure. I think the recent budget had made some significant changes to the tax structure. So if you look at the way the documentation was, if you have an equity exposure of less than 35%, now you pay the marginal slab rate of income tax. If your equity exposure is higher than 65%, then you pay equity taxation, which is 15% short-term or 10% long-term capital gains. But in the middle sits the products which have an equity allocation which is higher than 35% but lower than 65, which is like, say, a multi-asset fund, where for a multi-asset fund, you effectively get the indexation benefits as well. So in the short term, which is less than 3 years, you pay about the full marginal tax rate, but beyond 3 years, you start paying the old indexation benefit-based tax regime. So it can be a very interesting opportunity for investors who are not in the lowest tax bucket, but would like to have some tax advantages. Then they could consider a multi-asset fund where the equity exposure could be around 40-45%, and you'd have an element of gold as well, which is about typically tends to be between 10 to 15 odd percent, and you get the indexation benefits over a 3-year time period.
Okay, interesting. So, Ruchit, talk to us about SBI mutual funds process when it comes to asset allocation and multi-asset funds. You mentioned how this works for investors as well.
Sure. In that laddering of the risk spectrum that we spoke about, right? So you have two products within the hybrid category which have a very clean, simple investment process, right? So the debt hybrid, there's a maximum of about 25% into equity. The equity hybrid does a minimum of 65% into equity. Typically, on average, that's about 70-75% equity. So those are very clean, simple asset allocation, 25% equity debt versus the reverse of 75% debt equity. In the middle, you have products such as the equity savings and the balanced advantage fund. Both of them, we manage the equity exposure a little bit more dynamically. So we have an asset allocation strategy which looks into how earnings have been panning out, what the valuations are, what is the prevailing market sentiment, looking at bond deals, etc., and determine whether one should be overweight or underweight equities, and consequently allocate the exposure to equity within these funds. For our multi-asset fund, we have a slightly more unique way of allocating the different asset classes. We typically look at what is the volatility of each asset class, and depending on the volatility factor, we determine whether one should be adding exposure to gold or equities or fixed income. The idea here is that most of the three of these asset classes tend to be very poorly correlated with each other, especially if gold, right? Gold and equities tend to be inversely correlated. So therefore, they add a bit of cushioning, particularly on poor market conditions that's there. So we use asset allocation models to help determine what is an optimal allocation, rather than leaving it up to, say, an individual who may or may not be biased towards various market information and flows.
Okay, got that. Ruchit, that is a very helpful chat on hybrid funds as well as SBI's own model on asset allocation. So thank you very much for joining us and taking us through that quick explainer. But with that, we are going to get into a short break. On the other side, we have lots more lined up. We'll also be speaking with Prateek Oswal of Motilal Oswal AMC to talk about the big rise that we've seen in passive investing in India. So stay tuned for that.